Hello. Welcome to our next chapter, that is your IND AS 101, which talks about your first time adoption of IND AS. So basically, any company, any corporate, when they are going to choose IND AS, they are going to incorporate, they are going to make the financial statements as per IND AS for the first time. This uh, is for them. So objective is to ensure that the first IND AS financial statements, because before this the financial statements were not being prepared as per IND AS, and its interim financial statements contain quality information that provides the suitable starting point. Next, entity shall prepare and present an opening IND AS balance sheet on the date of transition to IND AS. So it is very important to understand when we say at the date of transition, what do we mean by date of transition? So date of transition, when we say date of transition, it is not that if an entity has, say for example, decided that we will start preparing IND AS from 9th October, so that will be a date of transition. No, if the entity has decided 9th October, okay, so it will not be 9th October, it will be some other dates. So date of transaction is the first day of the previous year from when it is required to prepare IND AS. So from the previous year, so say for example, if the IND AS is applicable from say 1st April 2025, if it is applicable from the year, from the date 1st April 2025. Now, when we say 1st April 2025, this means, of course, for the year 25-26. For the year 25-26, of course, you will have to prepare as per IND AS. However, as you know, when we prepare financial statements, you also need comparative financial statements. So therefore, you will also have to prepare for the financial year 24-25, that is your previous year. So therefore, you will have to make financial statements as on 24-25 and financial statements as on 1st April 2024. That means for 24-25, you have to make both opening and closing balance sheet. Okay. Now there are certain transitionary items which are important. Transitionary item means some items as to how you have to deal with them. So let's talk about first is your share based payment. Okay. So your share based payment depends upon the treatment depends upon whether the shares have been vested or not. So if the shares have been vested but not exercised, see, if they have vested and they have been exercised, then they are over. I have nothing to do with them. But if they are vested but not yet exercised, in such a case, they have two options. They can either continue previous gap value, whatever was being followed up till now, they can either continue doing that, or they can now come into fair value. They can now present it as per fair value if the information is available. So when the options are vested, that is our first case. This is your case number one, and this is your case number two. So it says when the options are vested, expense recognition in P&L has already happened, because as you know, we recognize expense over the vesting period. So therefore, they say that when the options are already vested, expense recognition has already happened. Hence, option is given to choose either fair value, or you can do it as per previous gap value, whichever is convenient with you, because the P&L recognition has already been done. However, in case of unvested options, the entire P&L impact has not been given yet, and therefore there is no option but to follow fair value as per IND AS 102. Great. This was your share-based payment. Coming to your next part, that is your foreign exchange items. So in case of foreign exchange items, we make the foreign currency translation reserve. So the foreign currency translation reserve will either be reset to zero. That means any balance in your foreign currency translation reserve, it will be set to zero by transferring it to retained earnings. That means this account will be emptied. Or you will retrospectively apply IND AS 21, and you have to calculate how it will be as if IND AS was always followed. Therefore, it says retrospectively IND AS 21. And any foreign exchange gain loss on long term loans, any foreign exchange gain or loss on long term loans. So if these are existing loans whose gain or loss is amortized, so if there are existing loans whose gain or loss are amortized, in such a case, you will continue either the previous gap or apply IND AS 21, whichever is convenient. So therefore, you have been given both options. Either you follow the previous gap or you continue as per IND AS 21. However, if there are any new loans or existing loans which were adjusted against P&L, any new loans or any existing loan that were adjusted against P&L, for that you will have to apply IND AS 21. You do not have an option to continue the previous gap value. Next is your PPE intangible assets and investment in your subsidiary, associate or joint venture. So for these, you will have to retrospectively follow IND AS, or if you are following the deemed cost method. In such a case, if you are following the deemed cost method, then it will be either your previous gap carrying value or your fair value. Okay, there is just one little, I hope you've noticed that over here, I have considered fair value. So for investment property, if you remember investment property when we did the IND AS, fair value option is not available. Investment property cannot be valued at fair value. So therefore for investment property, this fair value option will not be available. Investment in subsidiary, associate and joint venture can optionally also be shown at cost. Okay. Next is your compound financial instrument. So your compound financial instrument, you will be splitting the existing convertible instrument into liability and equity components. So because in under AS there was no option of liability and equity, only under India do we have this. So therefore your compound financial instrument will have to be split into both the portion, that is first is your liability portion and second is your equity portion. Coming to the next, that is your business combination. So either you do not restate any business combination. So any business combination that you've done previously, you do not restate anything, do not touch them. As long as you don't do that, it's okay. But if you want to do a particular business combination, then you will have to retrospectively restate all past business combinations from a particular date. Say for example, today we are on 9th October. 9th October 2024. Say for example, some business combination I had done in 2021 1st April. If I had done any business combination on 1st April 2021 and that business combination I want to restate, then all business combinations after that date will have to be restated retrospectively. Okay. So therefore retrospectively restate all past business combinations from a particular date. And this includes your NCI, that is your non-controlling interest as well. Great. Next is your government loan at below market rate. Government loan at below market rate. Say, for example, you got a loan from the government at 5%, but the actual market rate of the loan is suppose say 12%. So you got it at a discount of 7%. So you will have two options. You either continue recording the loan as a financial liability. That means if you, and under financial instruments, we know that we'll have to show the loan at a different amount. So either you continue recording the loan as a financial liability as you were doing as per the previous gap value, that is you do not change. Either you continue doing that or and recognize no grant benefit. So if you've already recorded it at whatever price you've gotten it and you have not done any changes to it, as per AS there was no such change available. So therefore you continue recording it as a financial liability and no government grant benefit will be recognized. Or you will have to retrospectively restate present value of future payment using the market rate. This is what we do in your financial instrument. Whatever future payments you have to do, you discount it using the market rate and then you get your financial liability amount. Correct? And the balance will be recognized as a government grant. So either you do that or you continue doing whatever you are doing. So this is your first option, that you continue doing whatever you're doing. And this is your second option, that you show all your payments to be made as per the current market value, discounted using the current market value. Next is your investment in joint venture. Investment in joint venture. So as per IND AS 27, you have to proportionately bring assets and liabilities into the balance sheet. If there is any joint venture, you have to bring proportionate assets and liability into the balance sheet. IND AS requires it to be shown as investment in joint venture. Sorry, did I say IND AS over? As per AS 27, you have to bring proportionate assets and liabilities, but IND AS requires to be shown as an investment. That means assets and liabilities will not come into the balance sheet, in our balance sheet in case of a joint venture. So investment amount would be the carrying value of all assets and liabilities, including your goodwill, and then you multiply it by your proportionate share. So investment would be the carrying value of all assets and liabilities, including your goodwill. Great. Next is your financial instruments. So you have to see, in case of any financial instrument, whether my EIR, that is my effective interest rate, whether my effective interest rate can be determined retrospectively or not. If the answer is yes, that the EIR can be determined retrospectively, in such a case, you will have to retrospectively restate and determine the carrying value as per your IND AS 109. IND AS 109 videos will also be there. However, if EIR cannot be determined retrospectively, in such a case, it will be the fair value on date of transition will be your new carrying value. So basically, you have to identify what will be my new carrying value. So either you retrospectively restate everything and determine carrying value, or you determine carrying value as on today, that is fair value on the date of transition will be your carrying value. Okay. Next is any estimates. Any estimates which are required by previous gap. If the estimate was required by a previous gap, yes, and there was evidence of error. Okay, so let's first do the easy part. If it was required by previous gap, if the answer is no, then in such a case, make estimate reflecting condition and relevant date. That means if IND AS requires me to make an estimate that was previously not needed to be made, in such a case, I will make the estimate at as on relevant date. That means whenever I am making the financial statements. If this estimate was also required by previous gap, okay, so the answer, if this answer is yes, then we see if is there any evidence of error. So if there is an evidence of error, that means the previous value cannot be trusted. So if the previous value cannot be trusted, that means the answer is yes, there was an error earlier. In such a case, again, we come back to the same part, that is make estimate on the relevant date. If there was no error previously, that means the estimate was correctly determined. And if it, whether is it consistent with the IND AS or not, whether the previous estimate as per AS or whichever gap we are following, is it consistent with the current IND AS? If the answer is yes, then you use the previous estimate. That means basically, if you see, we've got, was the estimate required earlier? Yes. Was there any error? No. Is it consistent with current IND AS? Yes, then of course use that amount. Na? Then there is nothing to change. However, if it is not consistent with this IND AS, then in such a case, you use the previous estimate, also give adjustment to reflect the current IND AS. You use the previous as a base and then give any plus minus effect adjustment as per the current IND AS. And with this, we are done with this IND AS, and I will see you in the next one, that is investment property.